This is the stock chart for Lordsmark. To anyone watching the exchange, it looks like a total wipeout, a 90% plunge from hundreds of rupees down to just 63. Typically, a vertical line like this signifies a corporate death spiral. It signals a massive scandal, an imminent bankruptcy, or a vanishing leadership team. But Lordsmark didn't go bankrupt. Its factory stayed open, its operations continued, and the business itself remained healthy. This creates a direct contradiction: a functional company paired with a stock chart that suggests a total collapse. Finding the source of that contradiction requires looking past the price tag and at the specific mechanics the company used to enter the public market. Lordsmark bypassed the traditional IPO process. Instead, they used a reverse merger, absorbing into a smaller pre-existing shell company already on the exchange. Before this merger, that listed shell company had a limited supply of stock, with only 10 lakh shares available for trade. Because those shares were so rare, even small amounts of buying activity pushed the shell company's price to an inflated premium on the formal exchange. While the shell company traded on the exchange, different activity happened in the unlisted market, where private Lordsmark shares were being bought and sold by speculators. In this unregulated gray market, eager investors were trading shares at prices ranging from 88 to 230 rupees, driven largely by anticipation and hype. By the time the merger was finalized, both the public shell and private company were trading at prices far ahead of their actual mathematical value. The turning point for the stock chart arrived exactly when the two companies officially combined. To finalize the deal, the company restructured its capital. They didn't just keep the original 10 lakh shares, they issued more than 42.6 crore new ones. This is the mechanism of share dilution. You can think of the company's total value as a single pizza. Even if the company grows, the size of that pizza stays the same in the moment of restructuring. The company effectively took that same pizza and sliced it into 400 times as many pieces as before. Because there are vastly more slices now, the value of each individual slice must shrink to keep the math consistent. When these newly diluted shares finally hit the open market, they entered a period of price discovery. On the floor of the BSE, the market looked at this massive new supply and found a stabilized value of approximately 63 rupees per share. The fall to 63 marks the point where the massive weight of new shares finally grounded the speculative prices. If we revisit that initial price chart, we can now see it represents two different realities joined by a single line. The high prices on the left were the result of the old shell company's low supply and the speculative hype of the gray market. The 63 rupee level on the right is the post-merger reality, reflecting the new, diluted share count. Measuring the distance between these 2 points is essentially comparing apples to oranges. The capital structure changed so much that the old price is no longer a valid benchmark. This is why you cannot judge a company's financial health solely by the movement of its stock price. Without understanding the total number of shares and how the capital is structured, the price chart only tells half the story. Next time you see a 90% drop, look closer. They might not be collapsing. They might just be cutting the pizza into smaller slices.